Hey ladies and gents, Bratt here with the Real Estate Jedi of Big Block Realty, here with your month of September 2019 San Diego County Real Estate Market Update. Let's go ahead and get started. So as we dive in here, this is going to be a little bit shorter of a market report video than we have had in the past, just because there's not a whole lot of crazy new news as of right now. There's a lot of volatility in the national market outside of real estate, and then some things that we're going to keep our eye on and look forward to in the coming weeks and month. But for now, let's just go ahead and touch on the basic numbers that we always look at. And right now we're looking at active listings in San Diego County. We're just down about 14% year over year from where we were last year in active supply. And yet we are still up about 10% from where we were 2 years ago. So big picture, we're still higher than we have been in the past, which is preferable to buyers as opposed to being down here. But nonetheless, we're, I think, going to continue this downward trend. And of course, as we've addressed in the past, every single year, pretty much, inventory is usually going to reach lows in December. So we can expect to see this inventory go down until we hit the end of the year. And then in January, typically speaking, we have a little bit of a spike as people want to have a fresh listing for the new year. So we can continue to see this go down. New listings are down 12.1% year over year. That's active. It's new listings coming in the market for the first time, not refreshes from expired listings or anything like that. Pending sales are up about 13.5%. We can typically expect to see this in the sold listings figure in the following month. And we can see in sold listings, we're down about 1% year over year. If we look at monthly inventory, months of inventory, we have about 2.6. So if we did not get any more new inventory for the coming months and everything was just to sit on the market and sell at the current rate it's been selling at, then we would look at about 2.6 months from now before all that inventory would be liquidated. And active market time is up 14.3%. So a little bit longer average market time that properties are on the market before they close. But nonetheless, it's nothing crazy there. Let's go ahead and look at sales price too. We're up 1.6% year over year, which in the big scheme of things is very much unchanged from where we were last year. But of course, as we know, this is how the chart looks for housing appreciation. It's not the little increments or even just year over year. It's the trends overall. So if we were to, for example, still look at a rolling 12-month cycle, if the thing will load up, this basically just takes every data point and averages it with the 12 months preceding it. So each one of these data points is pretty much an average of the 12 months behind it, which gives us a bit smoother of a curve so we can kind of just see the trends as opposed to the little spiky up and down each and every month. So if we look at it this way, we're up 2.7% year over year. But nonetheless, we can also see here we've had a little bit of a flattening, but also that's due in part because it's averaging together much of last year's slowing in prices as we had higher interest rates and an increase in inventory for a brief period of time. If we look at interest rates right now, we are currently sitting around 3.56% as of the making of this video nationwide for a 30-year fixed rate, according to Fred Economic Research. We are nearing 3-year and 7-year lows as far as interest rates go right now. But depending on what goes on with the Fed's meeting on the 17th and 18th, we might still continue to see interest rates trend downward even further. As we've noted in many videos in the past, you can go look at some of our more recent videos, such as the one titled something about 2% interest rates. My opinion personally, is that I think, barring any crazy boons to our economy, or even possibly the global economy as well, because many of these decisions are actually made in a big perspective, looking at the entire global growth as far as GDP goes. I think that we might continue to see this come down and actually go even lower than we've ever seen in the past and hit absolute record new lows, actually possibly getting down to negative interest rates as it pertains to the federal funds rate, which would just simply mean much lower interest rates for mortgages likely than we have even been seeing here in the recent past, which is incredible. I mean, we're in the 3%. So again, check out the other videos we've made in the past, and we will of course continue to follow that and see what's going on in the future. Again, I mentioned the Fed has a meeting this week on the 17th and 18th. General consensus is that they will most likely be dropping the federal funds target once again. Right now we're sitting at about 2 to 2.25%. So if they drop it another 25 basis points, that would probably put the federal funds target at 1.75 to 2. Which would, once again, not directly correlate to mortgage interest rates immediately, but typically speaking, will influence them and put downward pressure on them in the coming months, or even immediately, but typically in the coming months, we will start to see that as the supply of money becomes a bit more readily available. So anyway, that's where we currently sit right now. We will be following what the Fed's decision is and covering that in future market updates. As always, if you haven't subscribed already and you would like to continue being the first to have these market updates each and every month, feel free to subscribe to our YouTube channel. And of course, if you found any value in this, please share it, like it, and comment below, and let us know also any other future topics that you'd like us to cover. I know there's been a few suggestions in the past, and I apologize that we haven't gotten around to making those quite yet, but we will do our best to continue to provide relevant information for you in the coming weeks, months, and years. As always, thank you for watching, and I will see you in the next video.